Hey everyone, welcome to today's Explainer. Let's jump right in, shall we? Today, we are unpacking a really fascinating playbook of corporate resilience, looking at Fifth Third Bancorp. We're going to dive deep into their 2026 strategy to see exactly how a major regional bank thrives, grows, and, rewards its shareholders, even while it's under intense regulatory scrutiny.
Here's our roadmap for today. We'll quickly cover the Federal Reserve stress tests, then move on to Q2 financial performance, the Comerica integration, their strategic branch expansion, and finally, wrap up with executive pay and performance. Let's get to it.
Chapter 1. Federal Reserve Stress Tests. So the Federal Reserve building in Washington, D.C., it really stands as a stark reminder of the immense stakes involved here. The Fed's whole job is to promote the safety and soundness of the U.S. financial system. And every single year, they put major banks through these grueling hypothetical scenarios just to make absolutely sure they won't collapse when the economy, goes south. It's basically the ultimate test of a bank's defenses.
Looking at Fifth Third's specific 2026 stress test figures, the Fed modeled what they call a severely adverse scenario. So before setting aside money for potential bad loans, that's their pre-provision net revenue, they project $8.2 billion. But under this hypothetical disaster, they'd actually need a hefty $9.8 billion provision just to cover those loan losses, which brings their net income before taxes to negative $1.6 billion. Now, I know that looks totally daunting on paper, but what this actually proves is that they have the massive capital reserves required to weather a major economic storm.
And honestly, this perfectly captures the mindset you need to navigate those potential storms. Check out this quote from Tim Spence, Fifth Third's chairman, CEO, and president from their Q2 earnings call. He said, "Our job is to stay disciplined and to build durable franchise earnings, not simply to enjoy the cyclical boosts." He's explicitly noting that they prioritize stability, profitability, and growth, literally in that exact order. It's a great pivot from macro regulation to micro execution. They aren't just, riding the wave of a strong economy, they're building a fortress.
Moving on to Chapter 2, Q2 Financial Performance.
Okay, our first big win here is $1.02, while their standard GAAP earnings were 83 cents. If we back out some one-time merger costs, we get an adjusted earnings per share of a really impressive $1.02. This totally beat market consensus, and it just proves the core franchise is performing incredibly well.
Now, the obvious question is, how did they pull that off? Well, it comes down to 3.36%. That's their net interest margin, or NIM, and it actually expanded by a solid 6 basis points sequentially. Listen, in a complex rate environment, growing your margin is incredibly tough. But they managed it through the continued benefit of fixed-rate asset repricing and some really rigorous control over their deposit costs.
Next up is 19%. That is their adjusted return on tangible common equity. This metric basically shows how efficiently the bank is generating profits from the actual, hard, physical equity that shareholders have entrusted to them. 19% is massive profitability momentum. Oh, and to add to that, their tangible book value per share actually went up 10% year over year.
And rounding out the financial highlights, we have the adjusted efficiency ratio. Fifth Third managed to drop this down to 57.1% for the quarter. If you're not super familiar, in banking, this metric just shows how much a bank has to spend to make a dollar of revenue. So, lower is always better. Hitting 57.1% shows fantastic expense discipline, which is especially crazy when you consider they're still right in the middle of a massive merger integration.
Which brings us to Chapter 3, the Comerica integration.
We can really distill this whole integration down into 3 major operational wins. First off, a staggering 99.4% retention rate for Comerica commercial clients. I mean, that is practically unheard of in large-scale bank mergers, where competitor poaching is usually just rampant. Second, their technical systems conversion is officially locked in for Labor Day weekend 2026. And third, once that conversion actually happens, it unlocks the remaining $850 million in expense synergies. Like leadership pointed out, the earnings power of this combined company isn't just some future forecast anymore. You can see it materializing right now in their fee lines and expense discipline.
Chapter 4, Strategic Branch Expansion.
This highlights a brilliant dual-pronged approach they're taking. In the Southeast, they're basically opening 1 branch a week, targeting 55 new ones for the full year of 2026. And it's definitely paying off. Consumer checking households in the Southeast grew by 7% year over year. But meanwhile, they are making this massive, long-term play in Texas, targeting 150 new retail locations by 2029.
They're taking the exact playbook that worked in the Midwest and Southeast and applying it directly to those booming Southwest demographics.
So are those Southwest investments actually paying off? Well, the Q2 earnings data revealed a staggering $2.5 billion in deposit inflows coming specifically from those Southwest markets, all in a single quarter. Management even pointed out that this is double their prior expectation. They're capturing new customers at a rapid pace, and it's heavily fueling the bank's wider lending and investment engines.
Finally, Chapter 5, Executive Pay and Performance.
Charting total shareholder return, or TSR, over a 5-year period tells a pretty compelling story. Let's assume a $100 base investment back in 2020. You can clearly see Fifth Third's TSR consistently outpacing the broader KBW Bank Index. By 2025, that $100 in Fifth Thirds grew to $204.21 compared to just $196.02 for the index. And if you dig into the proxy statement, it clearly shows that executive compensation is heavily tied to metrics like adjusted return on assets, efficiency ratios, and this exact TSR outperformance. It's a great sign because management is clearly aligned with investors. When the shareholders win, the executives get rewarded.
As we start to wrap up this explainer, let's just quickly summarize the core principles that allowed Fifth Third to achieve all of this. It really comes down to this simple framework: stability, achieved through a resilient balance sheet; profitability, driven by net interest income growth and super strict expense discipline; and growth, accomplished through precise demographic targeting. Sticking to these principles is exactly what let Fifth Third recently cross the $300 billion asset mark, officially elevating them to a Category 3 bank. That is a massive milestone, supported entirely by their long-term investments in risk and reporting infrastructure.
I want to leave you with one final, provocative thought today. We've seen their resilience in the Fed's stress test, that massive Q2 earnings beat, and a literal tidal wave of deposit inflows. So, with the Comerica integration entering its final stage and $850 million in synergies about to unlock, is Fifth Third uniquely positioned to completely dominate the Southwest banking market in the coming years? It's for sure going to be fascinating to watch their next moves. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I will catch you next time.